newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, UK gilts paring some of their losses after the Prime Minister Keir Starmer says Rachel Reeves will stay on as Chancellor as he sought to end speculation about her future. Markets had tumbled after a tearful appearance by Reeves in Parliament, fueling rumours that she was about to leave her position. It came after Starmer failed to back her fully during Prime Minister's questions after an embarrassing U-turn on the government's flagship welfare reforms.
The fact is, Labour MPs are going on the record saying that the Chancellor is toast. And the reality is that she is a human shield for his incompetence. In January, he said that she would be in post till the next election. Will she really?
Prime Minister, she certainly won't. Mr. Speaker, I have to say I'm always cheered up when she asks me questions or responds to a statement, because she always makes a complete mess of it and shows just how unserious and irrelevant they are.
How awful for the Chancellor that he couldn't confirm that she would stay in place.
Well, we're now joined to talk about all of this by Subitha Subramaniam, Head of Investment Strategy at Sarasin and Partners, Adam Blenford, our Managing Editor for the MEA News Desk, and Marina Konyam, who covers UK markets for us. So this is a truly team effort to try and understand what's going on. Adam, I mean, what did you make? You know, it was pretty extraordinary, actually, watching everything unfold yesterday. Starmer has since given an interview to the BBC saying, look, Rachel Reeves will stay on as UK Chancellor despite some of the setbacks. I mean, is that locked and loaded?
According to him, it is, yeah. It's one of those, as we've had quite a few of them in recent years, extraordinary high-speed moments in UK politics where an incident, as you saw there, a heightened moment in Parliament, which was really quite intense, looking back on the clip there, you know, that classic head-to-head of Prime Minister's questions, putting people really in the personal spotlight, sparked that market sell-off, as you talked about. And then Starmer came out last night, perhaps having failed for whatever reason to overtly back his Chancellor in the chamber. He came out and gave an interview to the BBC, and he was really, really effusive. You know, we're in lockstep. We work together. We think together. Rachel Reeves, according to the Prime Minister, is going to be Chancellor for a very long time through the next election. So he has now, interestingly, tethered himself very closely to her, but the markets may have retraced some of their ground, but we don't know yet. We haven't heard from Rachel Reeves herself. We haven't understood what was the cause of yesterday, but equally, none of that changes the UK's fiscal position, as I'm sure you'll talk about with your other guests in a second. None of that changes the wider position, which has put the pressure on Rachel Reeves and put the focus on Keir Starmer in the first place. So the story has a long way to go.
Yeah, and Subitha, I mean, apart from the fact that it's actually a very uncomfortable watch because of, you know, you don't really know what the Chancellor's going through. It's the fact that, you know, gilts really moved on the back of it after the huge setback the day before because of the welfare mess, frankly. So how does the UK, I mean, it's a good reminder that, you know, markets are there and that the UK is a small open economy at the mercy of strangers. Like, where does the Chancellor and actually the Prime Minister go from here?
So I think the good news, the reason we have gilts rallying today is basically because they acknowledge that budget constraints do matter for the UK, and you just cannot sort of have a magical way of growing your economy without actually, either having spending cuts or raising taxes. So we now know that they will respect the budget constraints and Rachel Reeves will remain as Chancellor. But the fundamental questions for us as investors is really, can you tax your way into growth? Which is really where we're coming to, because I think everyone is now expecting that in the autumn statement we'll have tax increases. And the next question is, what kind of taxes and what will that do for the growth of the economy?
Yeah. We're just getting some breaking news. UK bonds actually extending against a 30-year yield, falling some 10 basis points to 5.32. Marina, I mean, this goes back to the reaction from the markets yesterday was really, really swift. And I wonder whether, you know, it's bond investors just being on tenterhooks, given what's happening in general, or is that there's always a concern, an underlying concern on the UK because of what happened with Liz Truss?
Absolutely. It was a very swift reaction yesterday. We are seeing that come back today, but we're still only halfway between the amount that the 30-year gilt actually rose at its peak yesterday. So we haven't fully clawed that back yet. I think it's quite interesting to look at what's happened to the 30-year gilt actually over the last few years. Now, it obviously did rise a lot yesterday, but not as much as it did on the global economic anxiety in April and May, and not even as much as the last time that everybody had a panic about the UK in January. But if you look back historically, those yields are still quite elevated compared to prior to the 2022 Liz Truss mini-budget situation. We haven't really come back, and that does mean that there's just no room for yields sort of going up actually becomes a self-fulfilling panic, because there's not much space already for the Treasury. Borrowing costs going up is a real problem because they are already historically very high.
So, Subitha, I mean, what does it mean for the budget? Does she go back and readjust? I mean, we don't really know where if it's the tax rises or where she takes the money from.
I mean, I think it's unlikely they go back to the welfare bill as a source of spending cuts. I mean, the sort of mind-boggling thing for us is really we do have the triple lock on pensions, which remains in place. And if you think about, how do we pay for this, that's not even on the table today. So it looks like we're just going to go back to tax increases as a way of paying for this. And I think that's actually quite negative for UK growth over the long term. I think something we haven't talked about is just the OBR's sort of adjustments of its forecast on the UK productivity. And that is going to actually cost about 10 billion. And so I don't know that actually, raising taxes ever more at a time period where the US is actually cutting taxes is going to make the UK more attractive, attract more investment into the UK. So I just think, we're in this sort of realm where the clear vision and economic strategy of this team hasn't really been spelled out. I mean, if they stand for growth, how exactly are they going to achieve that while respecting their budget constraints?
Yeah, and Adam, I mean, given what happened yesterday and all of these questions, I imagine the Chancellor will just be tested and tested and tested.
Yeah, and they can see now that the Labour backbenchers, who we didn't know what this group was when the government was elected a year ago, when Labour won that election with what was really a very large majority and over 400 members of Parliament. But it turns out that, of course, many of them have very small majorities. Some of them probably don't expect to be there in 4 or 5 years' time at the next election. They actually proved this week that they can make much more trouble for the government than perhaps it looked like on paper when you did the raw maths a year ago. And that backs up the idea that it's very difficult to go back to the welfare bill, as you said. Labour perhaps historically more comfortable with raising taxes, but as was said, what does that do for the growth environment? But Labour's project seems they've boxed themselves in from the very beginning, didn't they, with some of those pledges?
Does it mean? I mean, the Prime Minister, has been trying to chase reform voters, right, in the last 3 to 4 weeks. And now he has to keep the party together. So are we going to see, if not a radically different, policies that will change quite dramatically?
It's Keir Starmer always tries to chart what appears to be a kind of sensible, stable course, but his options continue to narrow because of so many of those commitments that they laid out really very early on. A commitment in the manifesto not to raise taxes on working people, a sort of refusal to go back overtly to raising income tax and VAT, and of course what the markets particularly say about the changes to the fiscal rules.
Okay, thank you all for joining us. Adam Blanford and Marina Konyam. Subitha Subramaniam from Sarasin and Partners actually stays with us because we turn to U.S. politics now, as President Donald Trump says the U.S. has reached a trade deal with Vietnam, giving zero tariff access to American companies while slapping a 20% tariff on all Vietnamese imports. Now, Hanoi has not confirmed the framework deal. So for more, let's bring in our EMEA News Director, Roz Matheson. So, Roz, essentially, what's the substance of the deal?
Well, we don't know a ton about it, as you say, beyond the headline numbers, which is 20% tariffs on Vietnamese exports to the US and 40% on transshipments. We don't know, for example, if Vietnam is getting anything in turn because they had asked for some recognition of being a market economy. They're also asking for lifting of curbs on high-tech exports. There's no detail as yet from Vietnam or from Donald Trump about whether any of that is included. So all we know are those headline figures so far. And obviously a big focus of this with Vietnam for the US has been transshipments, which is code for stopping Chinese goods coming into Vietnam and onto the US, and perhaps with a little bit of tiny production going on along the route. And that hence that 40% figure on transshipments. The question is, will that achieve anything, and how does that affect the Vietnamese economy? It's all about pulling Chinese production out of China, encouraging companies to relocate out and to curb those transshipments. We did see a rally in some shares yesterday on the back of this news from Donald Trump, and particularly textile companies, shoemakers and so on. A lot of stuff is made in Vietnam and moved on to the US. But the question is, like all these framework deals that we're seeing so far, there's a big announcement, not a lot of detail, and it seems like most of it is getting pushed back down the track. Let's get at least, say we've got a deal, and then we'll figure it out later in a way.
Rajaa, we have, of course, the Trump administration lifting chip curbs to China, which we'll talk about a little bit later, but there's also this big, beautiful bill. So where are we on that? And again, the implications are far-reaching.
Well, interestingly, we just got through this procedural vote in the House, and that had taken many, many hours. It dragged out Republicans using that as a chance to air their grievances about the latest version of the bill. And that had gone on and raising, obviously, Donald Trump's concerns. He was up on social media saying, guys, this should be easy. We need to get this done because we're edging towards his July 4 deadline on it. But it recently did pass that key procedural vote, and that means it is moving towards a full vote on this bill, and we may even get that in a matter of hours or into the US day at some point. But clearing that hurdle is a sign that perhaps they are having success at bringing these Republicans together, because they can only afford to lose 3 in all of this in the end. And what you've got is Republicans with differing views on either end, but they are making progress.
Yeah. Ros, thank you so much. Terrific update. Ros Matheson there with the very latest on the U.S. Still with us, Subitha Subramaniam. Subitha, I mean, when you look at actually all of everything that's happening in the U.S., I mean, there's tariffs, there's the bill. First of all, it will have an impact on inflation.
Yes. So, I mean, in terms of the One Big Beautiful Bill Act, I think our expectation is it does pass. It's actually going to have a fiscal stimulus into the U.S. economy this year and next. It's really a question of, how big it's going to be. Our estimates are anywhere from 30 to 40 basis points for both years. Now, if you just step back and think about what we expected in February and March, when Doge was, really all the rage, we actually expected that the U.S. economy would actually have a fiscal contraction. So now we are putting in place a fiscal impulse into an economy where we are starting to see fewer immigrants. We have an economy that's actually slightly softening because demand is pulling back because of tariffs. It's actually highly complex for businesses to navigate this. But, ultimately, I think just like the UK, but the US certainly enjoys an exorbitant privilege. No. The One Big Beautiful Bill is incredible in terms of just the lack of fiscal restraint. No. And there are no consequences for now for the US.
But Subitha, I mean, I've heard from more and more of people actually being worried, right? Big Wall Street saying at some point, we're not worrying about it now, we should, but at some point, something could happen with an auction, because you can't just print money like that. You can't have that much debt and not have any consequences.
So I think we are very concerned about just the complete lack of fiscal restraint as far as the U.S. is concerned. I mean, I think the CBO, the Congressional Budget Office, basically projected fiscal deficits of about 6%. Now, as a result of this bill and the version that was passed by the Senate a day or two ago, fiscal deficits are going to be running well above 7% forevermore, as far as we can see. And actually, that makes no sense. So there is no plan in place for the U.S. to actually pay for any of the spending. And if you think about it, Social Security, Medicare, and interest payments are roughly 50% of U.S. budget. So there is no plan. And for now, investors seem comfortable funding the U.S. government, but foreigners are becoming incredibly uncomfortable.
Subitha, when you look at tariffs, is that a way to get money in? Again, there are many questions on whether this is a negotiating tactic or it's literally just money in the coffers.
So from our perspective, I think now, for the month of June, the U.S. Customs basically raised about $28 billion in tariff revenue. So that really equates to around $350 billion if you run it at an annual rate. And now that's actually quite substantial.
I was going to say it's not nothing.
It's actually quite substantial. So set against a budget deficit of, say, $2 trillion annually, you are raising revenue. So I think of tariffs as basically a consumption tax. on U.S. consumers that they're putting in a stealth way. It has a secondary objective, which is basically to reshore a ton of manufacturing, which they consider strategic, back into the U.S. So I'm not sure that these tariffs ever go down, and I think they just start to inch up over time.
The employment figure today is extremely important because it gives us an indication of what the Fed could be looking at, maybe a bit of softening in the employment numbers. And we heard from Jay Powell, we were in Sintra doing a big panel with him, that actually he's worried that inflation does pick up in the next couple of months because of the tariffs.
Yes, and I think we are likely to have soft inflation over the next couple of months. It's coming about for a number of reasons. Just uncertainty. People do not know what's happening. So basically, no one is hiring and they're not letting go of workers. You have an economy in standstill. But at the same time, you have to absorb, if the government is raising roughly $350 billion in tariffs, someone is paying for it. Ultimately, it's being paid for within U.S. borders. So it's either U.S. businesses or U.S. consumers. And I think most people would assume that consumers pay roughly sort of 50% of that. So it's going to show up in inflation.
But the consumer remains strong. Because the U.S. consumer so far has always been there. If we start having doubts about that, then all bets are off.
So I think the U.S. consumer has been quite strong right now, but a lot of it is really reflecting the fact that a lot of spending has been brought forward. The U.S. consumer is incredibly smart. If you look at Q4 and Q1, they really brought forward a ton of imports from the rest of the world. They have been incredibly astute and actually much better than markets at actually forecasting that tariffs are going to go up. Having said that, though, I do worry about the impact of immigration on U.S. demand. We've had 9 million immigrants enter the U.S. and actually they have contributed to demand, housing, a whole range of goods. And I think, if we actually start turning that negative, where some people are actually expecting that, you will start to see a pullback in demand as well.
Thank you, Subitha. I love the idea of front-loading shopping. Subitha Subramaniam there, head of investment strategy at Sarasin and Partners. Coming up, an exodus of wealthy foreigners is accelerating after a UK tax crackdown. Our next guest says London is still the best place if you're rich and if you're young. We'll have more on that. This is Bloomberg. Welcome back, everyone. Now, we are keeping a very, very close eye, of course, on anything UK, given what we saw in Gilts yesterday. And, of course, the Chancellor, Rachel Reeves. Now, UK 30-year yields falling some 12 basis points, the biggest intraday drop since April. So we're keeping an eye on it. But a reminder, the Prime Minister did seem to give his full confidence in the Chancellor in a BBC interview late last night. Now, barely a day passes by without a big investor or a big entrepreneur leaving the UK after the government abolished a 2-century tax break for non-domiciled residents. Now, the exodus could lead to a net drain on the economy, but my next guest believes these reports are missing a crucial indicator, and that's age. Well, joining us now is Rajaa, Mekouar, Chief Executive of Calista Direct Investors, a firm that helps family offices to invest in private markets and alternative assets. So, Rajaa, thank you so much for joining us. Now, first of all, you're a believer in the UK. Why?
I'm a believer in London as a global hub for finance and private investments.
Okay, so that's a good start.
Yes.
Does anything change because of the non-dom rules?
Yes, of course. Money that made it, money that wants to look for something else than just hard work, has to look for a better shelter. But I think the UK lives this as a traumatic experience. If you look at France and other countries in Europe, they've been going through such motions for a while. And depending on what the governments do, wealth is very mobile. Wealth is flexible, but it doesn't mean that the actual capital, that the brain behind the capital has to leave. And I think that's where London still wins.
Rajaa, do you think that there's actually, there was, I don't know if there's a misunderstanding, that actually taxing, non-doms on everything that they have abroad was the big problem? So it's the ultra wealthy that said, actually, I don't need this, I can move elsewhere.
Absolutely.
Do you think there'll be a U-turn on that?
Well, I hope so, but I'm not a politician. And I know I've been working and looking after family capital in private equity for 20 years. And that wealth looks after its money in a different way, to any other asset owner. And the UK has been home for, 2 generations at least. So it is traumatic. But honestly, a lot of the resources stay here. The brain power is still here. And actually, London is a hub for deal making, whether we like it or not. And that's why we opened an office here.
And why do you think that is? Is it, the rule of law? It's always been seen almost like a satellite to the U.S., right?
Absolutely.
That it was a more mature market than some of the Central Europe.
That's a big factor. There's also the fact that there's critical mass here, and it's been here for so long. And I think London has been the home for private capital for so many years now. It was the first economy that also looked at private equity, although it's been caught up on by other countries. And what I see in my generation, a lot of people have left. But in the younger generation, they all look to London because there is no alternative in Europe.
And I guess, this is also universities. Is there anything that you would tell the government now to do to make sure that doesn't change?
Well, I would say, with Brexit, if you leave aside the non-dom abolition, I think Brexit has made hiring non-UK talent very difficult in London. Yeah. But just as it has made UK talent difficult to be hired in Europe, and we've experienced it both ways. So I think easing those rules for super talent, like we used to have these, high potential migrant worker type of visas, that's very important. Because without talent, there is no wealth creation and there is no wealth.
Rajaa, when you see, and it's, when you look at actually post-Brexit, there's more and more people leaving London for a number of reasons. So it could be tax, it could be non-doms. It feels like they're either going to New York, maybe a little bit less so at the moment because of some of the politics there, but certainly Dubai. Is there anywhere in Europe that's attracting talent? I mean,
look, Europe has become multi-hub. There was even a time for startups, it was good to live in Lisbon or Barcelona or Madrid. But honestly, if you want to have a serious institutional career in private equity and investment banking, no one replaced London. I don't think it's going to happen overnight, especially also because the largest market is the US and the first port of call for Americans is London. And speaking of taxes, our wealthy American families, when they come to Europe, their playground is London, and they own homes here, and the tax rules don't apply to them. So I think we should nuance this, but for sure, I'm not saying it's good news, but it's a bit more nuanced. And I would say the generation that's coming up now, looking to work hard and make it, still look to London as their first port of call as well.
And is that, for the wealthy Americans, is that, ease of language, but also rule of law, or is it something, or is it just the ecosystem that London has?
It's all of the above, and I would add something very important that we always overlook is the mindset, the way of work, the mentality. The bridge between New York and London is so easy to make if you just interact with people. If you go to Paris or Milan or Zurich, that changes very quickly.
When you say, that a lot of firms continue to open in London, including your own, is that again to test the market to then expand in Europe, or is it really just because London also has, the perfect time zone, it has a lot of benefits?
I think for Americans, it's the first port of call before maybe moving to other cities. But for us Europeans, it's really because we realize that a lot of the relationships for deal making transit through London, and so it's a good hub to come and centralize the meetings and create this kind of, critical mass of relationships and opportunities.
On the show we talk a lot about IPOs. When are we going to see a big IPO? Now there's talk about some of the big UK firms actually moving to the US because there's more of a liquid capital pool. Does that make a difference to your clients?
Well, family capital is long-term capital. It's also flexible capital. Yeah. So we look to exit, of course, at some stage, but it doesn't matter if it's short-term or mid-term, and what matters the most is it the public market that's the better option, or can it be other types of exits? I don't think that's a primary factor for decision-making of where you actually invest your money and where from.
So interesting. Thank you so much for joining us. That was Rajaa Mekouar, Chief Executive at Calista Direct Investors. Coming up, we discuss the latest in tech and VC investing with industry veteran Eileen Burbidge. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Relief rally, UK gilts rebound as Prime Minister Keir Starmer says Rachel Reeves will stay on as Chancellor after speculation about her future sparked a sell-off. Washington announces a trade deal with Vietnam and lifts some U.S. chip curbs on China. Plus, House Republicans express confidence that Donald Trump's massive tax bill will be passed to meet the president's Friday deadline as the legislation clears a procedural vote. Now, some breaking news. Bloomberg has learned that BlackRock is considering a sale of its stake in the leasing rights to Saudi's natural gas pipeline network back to the energy giant. Now, as far as we understand, there's no final decisions that have been made, and there's no certainty that the deliberations will lead to a transaction. But again, it's interesting as we look at pipelines and future security of energy and the energy complex. Now, let's get on to tech. Now, with Meta hiring its new superintelligence team, robots in China playing football matches, yes, they are, and the IPO market beginning to pick up, the tech sector shows no sign of slowing down. So where does the UK fit into all of this? Well, joining us now, industry veteran Eileen Burbidge, a founding partner of Passion Capital and executive director at Fertifa. Eileen, so good to speak to you. I mean, there's a lot going on in this space.
Nice.
It's all about AI. Do you want to be an AI, or do you want to look at the margins?
You know, I was thinking about it on my way in, and it's so great to be back. So thanks so much, Fran. We've been chatting through the years for almost 10 years, I think. And when we first started chatting and I started coming on to speak with you, we spoke about tech and digital as its own sector. Mm-hmm. And we used to speak about the rise of tech and whether or not we thought this was going to be something that would affect other industries. And I remember saying then, I think over time it won't be its own sector. Mm-hmm. Similarly, I think, yes, there's lots of froth, there's lots of investment. All the movement and momentum is in AI right now. And I think over time, it's going to be a given. It will be part of any industry, any technology, any company, and any commerce that's still around in 5 to 10 years' time.
So when you look at, you know, I know you're raising a new fund to invest primarily in the UK.
Yeah.
Like, what opportunities do you see in the UK?
Yeah, so in the UK, I still think we have such a great strength of talent. I really do, especially with what's happening sort of socioeconomically with macroeconomics and the geopolitical climate. I really think our universities, our talent pools, really, really strong. We continue to attract people from abroad, whether it's from North America or from the continent. We've got the best university system really in the world. Imperial now ranked number 2 in the world. It's fantastic. And so I believe we still have the talent concentration here in the UK. I think we have the ambition. I think we're winning on the research front and in the labs. What we're getting better and better at now is commercializing. So I'm really optimistic about that.
I love hearing that. What do you think of the EU AI Act? So is there too much of a burden on actually EU companies?
I don't know that it's a burden. I think that at the same time, clearly the EU is trying to fund infrastructure as well, along with everybody else, right? The UK is trying to do the same. Everyone's trying to think of their sovereign approach to AI infrastructure and to make sure they don't have as many dependencies on import as they have had historically.
We've seen a couple of, I mean, there's been a lot of tech news in general, but, you know, there's been a Meta investment in Scale. Has that changed your approach to VC?
No, I don't think it had changed the approach to VC at all. I think these larger companies are always going to be acquisitive and really, really clever about it. And that makes sense. And frankly, from a VC's point of view, exiting to a business like Meta or having a company go public, the result economically is probably very similar. So I don't think VCs, sorry to be so cynical about my colleagues or even myself, we're not really picky about where the exit is. Trade sales great, listing is great, and I think the more opportunity there is, the better.
But so Monzo's thinking of listing either here or the U.S. Does that make a difference to you? You know, would it show if they list here? Does it change significantly to show the world that actually the UK is really attractive?
I think I've got to be careful here because I'm actually on the board of Monzo. So Passion Capital is the largest shareholder still. And so there's lots I would love to say, but I can't speak on behalf of the company or the board. If it were to list in future, clearly the decision does rest between the US and the UK. At the moment, it's the 7th largest bank in the UK, and obviously it's got more than 12 million customers now in the UK, so it makes a lot of sense as a UK story. But clearly, as it starts to develop its international approach, and as it starts to see that the US is very, very receptive to really profitable, really strong growing, really, really great businesses, that's something it has to consider as well. But those are conversations that I think are some ways out. It's early.
Eileen, I mean, is there something that frustrates you in the UK about, you know, scalability or how, for example, you know, the government is dealing with a lot of the tech companies? Because you laid out all the good things about the UK. There's a lot of things that this country could do a lot better.
I think that's true, but I think that's true about everywhere you are. I mean, I wouldn't be particularly happy or content if I was in the US right now either. So I think I'm an eternal optimist, right? I'm an investor, so I'm always going to see the glass half full. You're right, there's so much more that could be done. We could have a lot more sort of flexibility, a little less friction, but to me that's just opportunity. And I think it's about where we are on the spectrum and how that sort of journey has been. And again, we've been talking for years and years and years. We are so much further along than we were even 1 year ago, 2 years ago, let alone 5 or 10. And I really think the trajectory we're on is really, really strong. The UK is really, really poised to have a breakout.
Do you see actually a lot of capital coming from the US into the UK?
I think what we see now is really interesting because of what's happening geopolitically. We see a lot more capital looking at the UK because maybe it's even a hedging strategy. The U.S. feels a little less certain or predictable right now. You never know quite what's going to come out of the administration. And so for the investors of the investors and the sort of at the top of the funnel, you're seeing a lot more exposure or looking for exposure and hedge against the U.S. So we're seeing a lot more Asian money, a lot of Middle Eastern money, and a lot of continental European money looking at the U.K., much more than maybe it did before.
I mean, you see this, U.S. trying to fight when it comes to AI, and it's like a big race with a lot of implications. Does it actually materially make a big difference to companies in the UK or in Europe?
I think what will make a difference are tariffs, are the export sort of controls, because they will determine what they rely on for their needs. I think it's really interesting that's going to play out in the U.S. And China. And I tend to agree a little bit with what, Jensen Huang would say this from an NVIDIA point of view. But his view that the export controls preventing him from being able to ship more to China is really just going to give China an even greater sort of forcing function to develop their own IP and to accelerate their investments. So in a way, it's leading them to actually pay even closer attention and pour more money into it. And they probably would have anyway. The question is how much more have we spurred them on, or has the U.S. spurred them on because of their export restrictions?
I mean, what do you think is there actually a company that you wish you had invested in Europe?
There are lots. There are lots of companies. I mean, I still think, and sometimes we get credit for actually investing in Wise. Still love that business. Still love what Christo and Talbot have done with that company. That would be one that I'd loved. I'd always talked about Onfido as being an anti-portfolio company. But there's so much. I mean, that just demonstrates. Yeah. I think at Passion Capital, we've had such a great run. And we're so proud of Monzo, Go Cardless, businesses like Poly AI, Butternut Box. But there's still so many more that we would have loved to have been in. And that just means we have quite a rich and deep ecosystem here.
Eileen, so good to speak to you. Thank you so much for coming on. Eileen Burbidge, they're a founding partner of Passion Capital and executive director at Fertifa. Now let's bring you some other tech news. And OpenAI has agreed to rent a massive amount of computing power from Oracle as part of its Stargate initiative. Now sources say the rental will total about 4.5 gigawatts of data center power in the U.S. Oracle is also said to be developing multiple data centers across America to meet the additional demand from OpenAI. Tesla shares jumped after the car maker posted a less drastic decline in vehicle sales than the most pessimistic analysts feared. Now, the company delivered just over 384,000 vehicles during the last 3 months, down 13% from a year earlier. While that leaves Tesla in a difficult place to avoid another annual drop, some investors were braced for a plunge in sales of more than 20%. Now, coming up, as coffee prices fall, will you be paying less for your brew? Well, we'll discuss the outlook with Andrea, Illy, the chairman of Illycaffe. That's next, and this is Bloomberg. Welcome back, everyone. Now, Arabica coffee prices have fallen to their lowest in 7 months. Now, the return of dry weather has helped accelerate harvesting in Brazil, but concerns over global demand for coffee has seen roasters push up prices recently. Well, we're now joined by Andrea Illy, the chairman of the Italian roaster Illycaffe. Andrea, as always, thank you so much for joining us. I mean, it's a great pleasure because we drink a lot of coffee to wake up in the morning. How is the company responding to a decline in green coffee prices? I mean, what does it mean for the consumer at the end of the day?
So we did anticipate a decline because this was, you remember last time I was here, I said it's purely speculative. Turns out that there has been maybe possibly a surplus in the last crop and a substantial forecast for a substantial excess in production for the years ahead. So there are new plants being planted, new areas be developed, stocks which are piling, several countries which are producing, overperforming. It's typical. Every time you have the prices reaching a peak, then you have a production skyrocketing. And so we didn't increase price too much, so we kept our volume, increasing market shares, And of course, we will have an arbitrage between our cost, our margins, and the cost of coffee, which in the meantime is turning in a positive direction.
So, Andrea, does it change your outlook?
No, I would say I was a little bit more concerned after having made thorough studies. I had a long trip in the Minas Gerais area, where 50% of the Brazilian coffee is grown and 20% of the world coffee is grown. Last year was serious. Why? Because the first time in history, the Niño did impact. In 3 different areas of production, all 7 months without one drop of rain, and the peak temperature much ahead normal.
No.
Was it exceptionally? Probably yes, because last year the sea did increase as much as it did in the last 10 years. So therefore the Niño was stronger and the area of geographical area of influence has been higher. But good news, many different practices and investment for resilience, resilient agriculture, from regenerative agriculture, which is the most, let's say, the first step and most promising, irrigation, new techniques for, plant rejuvenation, renovation, new area development, as I said. So it's very promising to see how the market is reacting, because there is desperate willingness to produce coffee from the grower side.
I know, because the demand actually is increasing quite a lot, right, in terms of
not as much as it used to increase, because there has been a kind of a level off with the global let's say, as we knew it from years ago. It's not the same, let's say, buoyant trend. It is a little bit flatter, but China is growing its internal consumption. US is keeping increasing consumption. Europe is more flat. In the Middle East is coming up, and India, minor countries, let's say, minor geographies.
Andrea, I know you've always actually spent quite a lot of time looking at agriculture and doing it sustainably. Do you see any reason to fear a supply shock on the Arabica front this year?
I would say no, because as I said, already last year has been quite a shock with one drought in Vietnam, one severe drought in Brazil. It proved to be extremely resilient, as proven by the fact that there has been no physical deficit. It has just been a big alarm, which triggered a gigantic speculation. So this resilience can only increase thanks to the new practices, the new knowledge, and the new investment in the fields. This initiative, let's say, promoted by the G7 last year under the Italian presidency, is to launch a public-private partnership for mobilizing impact investment directly in the plantation. Is significant because it did mobilize efforts from any different possible actors, like the World Bank, like the Inter-American Development Bank, like many private funds. So there are investments which are, let's say, coming in the plantation in different countries, and all doing the same things, which prove to be, let's say, effective. So this is very positive.
Andrea, when you look at higher retail coffee, I mean, is that impacting some of the consumption, or have you seen, consumption change? Do people have higher quality coffee but less coffee?
Coffee is typically inelastic because we kind of need it in our life. And
that's true for journalists. I don't know if it's true for everyone.
And the portion of the budget that it drives is very, very small at the end of the day. So there is a kind of elasticity, not so much by drinking less cup, but wasting less and maybe downgrading a little bit the coffee you buy. So that means that volume-wise, we don't see a contraction of volume. Values has been, let's say, a little bit elastic, but less elastic than other products.
How are the Chinese consuming differently to the Western
They
world?
are becoming kind of internal. So they are trying to consume their own brands. So there are brands which are reacting really strongly to the international, let's say, penetration of American and other brands. So that means that they became a kind of internally focused. And I'm not aware about how much is the Chinese coffee production growing, also because there is a kind of a limit from the ecosystem point of view. But I see that there is in line with this idea of China to be kind of nationalistic a little bit in terms of attitude.
And they consume it at home or in coffee shops? I remember you telling me actually years ago that the UK, when you have a coffee, people want to sit and spend a long time actually at coffee shops, which is very different to Italy, for example, where you have an espresso and you go.
Yes, coffee shop is experiential. Yeah. You typically go to coffee shop in China to meet or show off. Yeah. But not necessarily you drink coffee. This is the point. At home is more, let's say, consumption as a habit, and it's still predominantly instant coffee. Although in the, let's say, area where there are more expats, there is a substantial espresso-based drinks consumption in Shanghai and other coastal cities.
Andrea, you must have been hit by tariffs, right, from the U.S. Did you front load? Was there a big shipments in the U.S. ahead of the tariffs?
10% from the export from Italy to the U.S., and we hope this will be fixed.
Will it?
I don't know. Will depends on the negotiation with Europe, which is undergoing those days. Yeah. And yes, it's tricky also because I think at the end of the day, it's a pity we have been there since over 45 years now in the United States. And it would be really a pity to completely, let's say, change our trajectory, which is very much in collaboration with the U.S., let's say, administration for that. So we are discussing, and we are planning maybe to accelerate our decision to produce locally more of the products which are typically consumed in the United States. We'll see.
So interesting. Andrea, as always, thank you so much for joining us. Andrea Illy there, the chairman of Illycaffe. Now, the ECB's Olli Rehn has also told us that euro area inflation could stay below 2% or the 2% target for too long. The central bank has forecast 18 months of inflation below its goal as U.S. tariffs dent confidence. Well, Rehn, who heads Finland's central bank, spoke to me at the ECB Forum on Central Banking in Sintra, Portugal.
We have to seriously look at the economic analysis at a time when we take decisions. And we have many challenges, many shocks currently. As I look at the landscape, we have geopolitical tensions, we have trade war, we have artificial intelligence that is changing the working life and industrial competitiveness. So all these factors play a role when we take decisions. And as I said, in the near term, risks to inflation are two-sided, and especially I would be quite concerned. I'm quite concerned about inflation being below target for an extended period of time. We have to stay vigilant and we have to be alert and act with agility as needed and if needed.
Governor, do you share the concerns of the ECB Vice President that a euro at 120 could be problematic?
Well, we are following closely the developments in the exchange rate, but the exchange rate is not a policy target for us. Our mandate is price stability, and we look at the exchange rate from that angle, how it affects our growth and inflation outlook, how it affects the strength of monetary policy transmission. And in fact, you can see different factors at play in this regard. The appreciation of the euro is affecting, if it is persistent, it is affecting cost competitiveness of European export industries. On the other hand, the recent international capital movements have reduced the term premia, and that has eased financial conditions while the other factors have tightened them. So in that sense, this is an empirical question, and we have to look at that once we take decisions.
But could you say that the euro has been of help to getting to the 2% inflation target, and now it could become a problem?
Well, that may be a bit simplified. That's your job, of course. But I would say that the appreciation of the euro has indeed helped us reaching the 2% target for now. Let's see if the exchange rate developments become more persistent or how they evolve, and we are monitoring that in light of and from the standpoint of our price stability mandate.
Well, that is the ECB's Ollie Rehn speaking to us in Sintra. Now, UK gilts rebounding after Prime Minister Keir Starmer confirmed Rachel Reeves will stay on as Chancellor of the Exchequer. Well, markets slumping sharply yesterday, amid speculation about Reeves' future, adding to existing investor concern about the state of Britain's finances. Our very own Ven Ram, our M-Life strategist, joins us now from Dubai. Ven, always so good to speak to you. I mean, this episode, frankly, hasn't been very helpful for easing market skepticism towards UK assets.
Morning, Francine. Good to be talking to you, and congratulations on the fantastic set of interviews out of Sintra. So on the UK, I think that the markets have kind of rallying hard. Gilts are rallying hard this morning, but I think that the risk premium that that traders embedded into UK assets is going to stay for a while, because the rolling back of those removal of those welfare measures means that the UK government is left with a fiscal gap of about 5 billion. As you will remember, in March, the government made efforts to restore the headroom, in the fiscal headroom that Reeves has set for herself. So that was 9 billion. So if they're going to surrender 5 billion, it raises the question, how are they going to make up for the shortfall? Spending has already been restricted. And in the context of UK, I think what looks most appropriate is further tax increases. And that is going to be a curious mix, because you've got fiscal tightening on the one hand and monetary policy loosening on the other hand. And that will kind of confuse the curve, and that will keep the curve steeper for longer. So I think that, while the relief rally in gilts today is welcome news for the markets, I think that investors are going to be erring on the side of caution. And I think that that risk premium is going to stay higher for longer.
Ven, turning to the U.S. and June's non-farm payrolls report out today. I know it's a Thursday, but tomorrow's the 4th of July, so don't panic, everyone. It's out in just a couple of hours. What are you looking out for?
Well, I'm particularly looking at the unemployment rate, Francine, because if you look at the market forecast, the markets are primed for a number of 4.3%. If that is accurate, that will be the highest. We haven't seen a reading like that since 2021, really. So that will be a pretty high number for the Fed vis-a-vis its own projections for this year. And if the number shoots to the upside, I think that the markets will be emboldened to price in further cuts. At the moment, the markets are thinking about 2.5 rate cuts from the Fed by the end of the year. But I think that if that number is on the higher side, I think that the markets will be emboldened to price in 3 cuts, meaning September and 2 more before December by the end of the year. So I think that, that is what the markets are primed for. I don't think that the markets are going to, even with a higher number, I don't think the markets are going to make July a central possibility, simply because inflation later this month is forecast to come in higher. So the Fed may want to watch the trend with the jobless rate rather than react to one-off high print.
So, Ven, I mean, what else, when you look at some of the reaction function, there's many question marks actually on. I mean, the ECB seems fine, but there are many questions on how Jay Powell reacts to a lot of things. How do you see inflation going, or how do you see the main vantage points over the next couple of weeks?
Well, I think that I think they are watching the inflation print like hawks, particularly because they want to see how this tariff drama is going to play out on inflation, and that is what they've been. That is what has been holding them up vis-a-vis further rate cuts. So I think that is going to be the most crucial factor, which is why I think that July is not in play.
So interesting. Ven, thanks so much. Ven Ram there, our M-Life strategist, of course, based out of Dubai. Up next, we have more market moves. We talk, of course, about UK and the non-farm payrolls. Bloomberg Brief, that's next, and this is Bloomberg.